We're here with Bryan Chavis of the Landlord Academy, bryanchavis.com, and he's also just started up Apartment Rescue, where he goes out and you actually help to rehabilitate apartments and acquire apartments. You've written a couple of books, Buy It, Rent It, Profit, which is a bestseller. It's also in the U.S. Library of Congress and also the Landlord Entrepreneur. So super excited to be able to pick your brain. This is something that I want to keep, we want to keep going like on a weekly basis. And so we're just going to start out with like one question. We'll get into the nitty gritty. So please, as you watch these videos, leave your questions in the comments. Make sure to like and subscribe. Bryan, thank you for being here once again.
Awesome. Good to be here.
I have a question, man. This gentleman asked, does it make sense to actually buy properties all cash? I know people think about that. They're looking at, taking out mortgages and things like that, but does it actually make sense to buy a rental property all cash?
Yeah. I mean, again, as we talked previously, let me make sure my camera stays. As we kind of figured the camera would go as soon as me and you hit, as soon as we get into the recording.
All good, man. We can redo that as well. So.
All right. No, that's cool. It's real.
Yeah.
Sorry about that. But yeah, is it wise to buy all cash? At the end of the day, it really depends on your equity, your group's, strategy. So, let's talk about, the impacts of buying cash, both positive and negative. I would say the negative, first of all, let me start by saying I purchased an apartment building with my group, all cash. We all Park Plaza Apartments. I'm sure a lot of people know who follow me. Was a cash purchase, all cash in downtown St. Pete. The negative is that of course the cash flows, the cash on cash returns are going to be extremely lower when you buy all cash. Obviously, you're increasing the returns when you employ the use of leverage. However, if the cash on cash returns are not the main strategy at that time, to find a property that you like, value add play, purchase that property, increase that property's value, and then perhaps use the equity in that property or the equity buildup in that property to then purchase other properties. That is the strategy ideally that we have. So, at one point or at some point, we're going to employ the use of leverage. We just didn't on this first move. Again, it's just a matter of, of your investment groups, their strategy and what returns they're offering. So the implications are, if you raised money, just the equity portion, then you're promising your investors a preferential return. Those returns need to be a certain number, 8%, 11%. These are anywhere between, I say 5 and 8% are normal prefs that we see out there. But if you're promising a return to investors, then you definitely want to use or employ leverage so you can make sure you're reaching those prefs. Because where the syndicator really makes their money is on the promote side. So anything after, let's say we set a pref of an 8% return, you invest with me, Nathan. I promise you that we bought a 40-unit apartment complex. It returns 8%. Anything after 8%, we split 70-30. 70 to me as the syndicator, the general partner, and 30 to you. That's a sweet deal for you because you're still making your pref, plus you're getting an additional 30% above and beyond your pref. And then, of course, you can build your waterfall structure from there. And typical waterfall structure will include IRR hurdles and various other hurdles. But mainly, though, to keep it simple and not get too deep into the weeds, the structure will be a simple cash on cash return, pref 8%. And then anything after that, you and I split, outside the normal syndicator fees that we may have baked in, such as a finder's fee, asset manager's fee, other fees like that. So really, it just really begins, buying cash. Then back to your original question, it's really, what have you offered your investors? What is your strategy? My strategy with Park Plaza was to buy something, value add, get something in the core market, take the rents, take the property from X, from A to B, take the rents from, an average of 750 to 965 where they are now, make a value add play. And then be able to sit back now and entertain the idea of extracting equity from that property. Now I have a track record. Now the banks can look at the rent rolls from Park Plaza where they were a year ago to where they are now and see me as a reliable syndicator, someone that has put in the work, done the work. They're looking at actuals, rent rolls. They see what I've done with that property downtown. And so now it would be a lot easier, I feel, speaking with our lenders to be able to secure the type of debt that I would, a more favorable, loan package. I could probably now, I feel like I'm sitting in a much better position to be able to negotiate, whether it be a non-recourse loan, whether it be a rate on that capital. I'm in a much better position to negotiate now that that we've owned the property outright, number one, and then that we've actually less than a year have turned that property around and stabilized it and increased its value. So so now moving forward, looking at another property, we can extract equity from property A that I've just completed in less than 365 days. And then, pull equity out of that and purchase another property. So, at the end of the day, it's really what you want your strategy to be. But, that's really the only negative of buying something all cash. But it might not be a negative to the person buying, because they might be saying, hey, look, I own it outright. I'm looking for a modest cash on cash return. It's really what their strategy is. Not everybody's in the same tax bracket. That's one thing that I learned. Is who are you dealing with? Because what you and I might feel is a tax benefit or is a need for an 8% cash return on a property, an investor might say, I don't need that. I'm sitting on $150 million. I'd rather have a tax shelter. I don't know. I'd rather move that money into real estate and get it out of the bank. So, you know what I mean? It's just, you have to understand who you're talking to and who your investor is or who your group is that you're investing with. So, at the end of the day, that's the 10,000 square foot, view or answer. But really those are the dynamics.
Okay. So you're saying you get faster leverage when you're going in all cash, being able to, go ahead.
I wouldn't say faster leverage. You get, going in all cash. You're securing the property.
Got it.
You're getting lower. You're getting a lower rate of return on your investment because you're not employing debt.
Okay.
However, if you need to put that money to work in real estate because you don't want it sitting in the bank for tax purposes, if you're a high net worth individual, it's a smart move. So, now you can then, find another deal and use that equity build up in that particular property A and go out and find another property, which I'm currently doing now. So, it could be a smart, it could be a wise choice. It's just, again, it's all about preference. Like I said, the only negative is if you're promising people a return, then you want to use leverage, because when you employ leverage, it increases your returns on that investment.
Okay. And you're going to get leverage with, how do you acquire? I'm sorry, I'm drawing a blank here. The leverage would come from owning the property outright, correct?
The leverage comes from borrowing other people's money.
Okay.
From a bank. So, that hard money lender, whoever you're raising money, typical, Fannie Mae, Freddie Mac, insurance companies, these are the typical lenders that you're going to go to for commercial deals, anything under, over 5 units. So whomever you go to create debt, a mortgage, that is leverage.
Okay.
That is what I'm saying, leverage. You're basically putting up 30% and they're going to come to the table with the other 60%. So you're looking at 60-30 LTV, loan to value. So you're going to put in 30%. You've raised 30%, 30% of $1 million or 20% of $1 million for easy, mathematical purposes. I believe is 800,000. So you're coming with 20% of that. and the bank is going to give you the loan for the other. That's the use of leverage.
Okay. Okay. Well, thank you. I mean, this is a huge question that a lot of people are chiming in here and are asking as far as, they've got all these different answers. So I wanted to get it from the source, So thank you very much, Bryan.
Yeah.
Once again, we are going to be doing this on a weekly basis. So please, subscribe to our channel. We're going to set up a podcast as well, so you can find us on our podcast. The links will be in the description below. Thank you once again, and like and subscribe. Thanks, Bryan.
Yes, sir. Thank you, Nathan.